The Jackson Hole Economic Symposium, held annually in Wyoming, is one of the most closely watched gatherings in global finance. Central bankers, economists, policymakers, and financial market participants from around the world converge on this high-altitude venue to discuss monetary policy, macroeconomic trends, and global economic risks. This year, the spotlight has been on Federal Reserve Chair Jerome Powell, whose remarks often set the tone for market expectations in the U.S. and beyond. In a setting where every word is analyzed, Powell offered subtle but significant signals hinting at potential rate cuts in the near term. Markets responded immediately, with major indices surging and currency markets adjusting to the prospect of easier monetary conditions. These developments have profound implications not only for investors but also for businesses, consumers, and the broader global economy. Powell's remarks at Jackson Hole came amid a complex macroeconomic backdrop. The U.S. economy, while still resilient in some sectors, is showing clear signs of slowing growth. Trade tensions, tight immigration policies, and lingering supply chain disruptions have contributed to uncertainty and volatility. At the same time, inflation, particularly core PCE inflation, remains slightly above the Fed's historical comfort zone, complicating the policy calculus. The financial markets are highly sensitive to these signals. Even subtle indications of potential rate cuts can lead to immediate changes in equities, bonds, and currency pairs as investors recalibrate their expectations for future interest rates, corporate earnings, and risk sentiment. The Jackson Hole Symposium, in particular, has a long history of influencing market behavior as traders and analysts anticipate forward guidance from central bank leaders. Powell emphasized a nuanced approach. While acknowledging that inflation has moderated, he also stressed that risks to the labor market are rising, suggesting that the Fed could adopt more accommodative policy measures if economic conditions warrant. This balance between price stability and employment growth is at the heart of the Fed's dual mandate, and it underscores the delicate decision-making involved in monetary policy today. The following slides break down the key points from Powell's speech: the current state of the U.S. economy, market reactions, currency movements, and the broader implications for investors and the global financial system. Each slide also explores context, historical comparisons, and potential risks for the months ahead, providing a comprehensive picture of why Powell's words matter so much to market participants and the broader economy. At Jackson Hole, Powell made clear that the Federal Reserve is actively considering a rate cut in September. This is a major signal, given that markets had previously been uncertain about the timing and extent of any potential easing. Powell acknowledged that risks to employment are rising, suggesting that if the labor market weakens further, the Fed may take action to support economic stability. The announcement immediately captured global attention. The Fed's credibility and communication strategy play a critical role in shaping market behavior, and even a subtle hint can have outsized effects on bond yields, equity markets, and currency valuations. Powell's remarks were carefully worded, emphasizing flexibility rather than a hard commitment, but the takeaway for investors was clear. The probability of a rate cut has increased substantially. Historically, Jackson Hole speeches have been pivotal moments for monetary policy. Past addresses by Fed chairs, including Ben Bernanke and Janet Yellen, have signaled policy shifts, forward guidance changes, and reassessments of economic risks. Powell's speech continues this tradition, acting as a market catalyst that affects investor positioning, trading strategies, and expectations for corporate financing costs. Beyond markets, the speech reflects broader concerns about economic resilience in the face of multiple headwinds. Inflation remains moderate, but sectors like manufacturing, construction, and consumer services are showing signs of slowdown. Powell's remarks underscore the Fed's commitment to navigating these challenges, balancing the twin goals of sustaining employment while containing inflationary pressures. The U.S. economy remains in a complex and nuanced state. On one hand, certain sectors continue to display resilience. Construction activity, service sector expansion, and consumer spending in specific areas suggest ongoing strength. On the other hand, overall growth and the labor market are clearly slowing, signaling that the current monetary policy stance may need adjustment. Inflation metrics provide critical context for the Fed's deliberations. Core PCE inflation, a preferred measure for policymakers, stood at plus 2.9% year over year in July. While this represents moderation compared to prior peaks, the number remains above the Fed's long-term comfort zone of 2%, keeping the central bank alert. Complicating matters are tariffs and trade tensions, which continue to put upward pressure on certain prices, particularly in sectors exposed to imported goods. Labor market trends also inform policy decisions. Wage growth has been steady but uneven, with some sectors experiencing tight labor supply and rising costs, while others face layoffs or hiring slowdowns. Powell noted that risks to jobs are rising, highlighting the potential for broader economic spillovers if weakness in certain industries spreads. In this context, a September rate cut would be both a preemptive measure and a signal that the Fed is ready to support continued growth without triggering undue inflationary pressure. Analysts expect that if the Fed acts, the move will be calibrated, carefully communicated, and contingent on incoming economic data, ensuring that markets do not overreact while still encouraging economic confidence. Markets responded quickly and decisively to Powell's remarks. The Dow Jones Industrial Average surged plus 1.82%, reflecting optimism among investors that lower interest rates will reduce borrowing costs and stimulate corporate investment. Similarly, the Nasdaq rose plus 1.83%, driven in large part by technology stocks, which are highly sensitive to interest rate expectations. The S&P 500 gained plus 1.52%, illustrating a broad-based rally across sectors. Even international indices like the Nasdaq Golden Dragon China Index jumped plus 2.5%, showing that global markets are closely linked to U.S. monetary policy signals. Investors immediately began recalibrating their expectations for September, with a growing consensus that a rate cut is now likely, shifting sentiment from cautious optimism to active positioning for an easier monetary stance. Market participants cited several reasons for the rally: lower borrowing costs. Anticipation of reduced rates improves corporate financing conditions. Improved consumer confidence. Lower rates can spur spending and investment. Strategic portfolio shifts. Investors rotate toward equities and riskier assets, anticipating central bank support. Overall, the immediate market response highlights the critical role of Fed communication in shaping both domestic and global financial conditions. Traders, analysts, and institutional investors closely monitor Jackson Hole remarks, and Powell's hints at rate cuts served as a catalyst for swift portfolio adjustments and asset reallocation. The U.S. dollar index reacted decisively to Powell's hints. Falling below 98, the dollar weakened against most major currencies, reflecting expectations of easing monetary policy. The yen strengthened past 147, the euro climbed to 1.17, and the offshore RMB surged to 7.17, indicating that global markets were interpreting the Fed's signals as supportive of more accommodative U.S. monetary policy. Currency markets are especially sensitive to interest rate expectations. A lower U.S. rate generally reduces the yield advantage for holding dollar-denominated assets, prompting capital flows toward other currencies. This ripple effect has implications for international trade, investment flows, and multinational corporate earnings, as exchange rate fluctuations influence costs, revenues, and competitiveness. Foreign exchange traders emphasized that the moves were directly linked to Powell's comments, demonstrating the immediate transmission of monetary policy signals across global financial markets. In a highly interconnected global economy, even incremental shifts in interest rate expectations can trigger large-scale currency movements, influencing trade balances, investment strategies, and international policy decisions. Looking at the broader picture, the probability of a September rate cut has risen sharply, from 75% to approximately 90%, based on futures market pricing and analyst forecasts. Powell's decision to drop references to an average inflation target and move toward a more flexible inflation goal reflects a willingness to adapt policy to real-time economic conditions rather than rigid numerical targets. This flexibility is critical. It allows the Fed to respond dynamically to labor market trends, inflation signals, and global economic shocks. Powell stressed that balancing jobs and price stability remains the key priority, reinforcing the Fed's dual mandate. Markets now expect a carefully calibrated rate cut in September, aimed at sustaining growth without reigniting inflationary pressures. Analysts highlight several takeaways. Strategic signaling. Powell's remarks demonstrate the Fed's ability to communicate intentions and manage market expectations. Economic support. Lower rates may provide targeted stimulus to sectors showing early signs of slowing. Global implications, currency movements, and international market responses underscore the interconnectedness of U.S. monetary policy. In conclusion, Powell's Jackson Hole remarks represent a critical inflection point for the U.S. economy, financial markets, and global monetary policy. By signaling potential rate cuts, the Fed aims to support growth, manage inflation, and maintain economic stability, while markets react immediately to the prospect of easier policy. Investors, businesses, and policymakers must all navigate this new landscape, balancing opportunity with risk.